Awesome. All right, so why don't we go ahead and get started? So again, I'm going to introduce myself. My name is Dustin Wozniak. I'm a mortgage broker based out of Edmonton, Alberta. So the content you're going to be hearing today is going to be Canadian-based content. So there's a lot of mortgage differences between Canada and US. So keep in mind that some of the content you're seeing today, if you're not based in Canada, and particularly Edmonton or Alberta, there might be slight variances, but we can have those conversations offline if you have additional questions outside of what we discussed today. So perfect. So quick agenda for today. Some of the things that we're going to talk about is we're going to discuss your equity. So in terms of equity, what is equity? So we're going to talk about that. We're going to break it down, explain it a little bit. We're not going to take too much time today, but we do want to make sure that you guys walk away from this understanding what equity is and how much you might have, right? So a lot of people, hear the word equity. I would say it's a little bit of a buzzword. And I do believe that a lot of people are unsure about what that actually means and how much they actually have. So we're going to discuss that a little bit today. We're also going to talk about what you can use your equity for. So it's great that you maybe have equity or don't, whatever the situation may be, but what can you do with it? So we're going to talk about that a little bit. And then we're going to talk about how you can actually access your equity. So there's a variety of different ways in which we can access your equity, your home equity particularly. And we're going to talk about some of those options. And then lastly, if this is a route that you're interested in pursuing further, we're going to talk about what those next steps look like. Okay, so this is just a general idea of what our agenda looks like today. Again, I love to go on tangents. So this is my first time doing one of these, YouTube lives. So bear with me in the situation where maybe I go a little bit off agenda here. But the general reasoning for any of that is, I want to bring you guys a little bit more education. So if there's any kind of concerns in terms of, what you're learning, I want you guys to make sure you're walking away with maybe a little bit of knowledge at the end of the day. At the very least, walk away kind of feeling like, you didn't waste the last half hour of your time, right? So let's continue with this. All right. So to get started, I wanted to talk about, and I mentioned a little bit in Alberta, this content is Alberta and Canada specific. So a couple of things to note, I wanted to talk a little bit about market stats, but then I thought, that's kind of boring. So I thought I'd kind of sum it up in a few short terms. In Alberta, what we're seeing right now, price of real estate over the last 5 years is up. Interest rates are down. So what that means is at the end of the day, had you purchased a home within the last 5 years or even longer, you have equity there and it's waiting for you. Whether you've accessed it yet or not, it could be waiting there for you in one form or another. And we're going to kind of get into the details of that. But what is there is your built-in savings account built into your home, that nest egg, so to speak, whatever you want to call it. It's there. It's ready to go. And we're going to help you figure out kind of how to proceed with it. So what is home equity? Home equity, like I said earlier, it's a little bit of a buzzword. The simplest way to figure out what home equity is how much money you have tied up in your home. So your home equity, the simplest way to calculate it is take your home's value, and I'm just going to use easy numbers for examples throughout this presentation. Take your home's value of, let's say, $100,000. Now, again, I'm using simple numbers just to make the math easy for us. Obviously, the numbers are going to vary a little bit here and there, but I have an example on the screen, a little bit more complicated to do the math on that one, so I'm going to give you guys a simpler calculation here. Imagine your home is worth $100,000. You have a $50,000 mortgage on that home. You have $50,000 in equity. So to do that calculation, you take your home's value, you subtract what you owe on your mortgage. So in the example on the screen, I have your home value at around $600,000. Let's say your mortgage balance is about $380,000. That means currently in home equity, you've got about $220,000 in equity. Now, the great news is you don't need to sell your home in order to access that equity. And we're going to go over that as we kind of proceed. Okay. Now, the next slide that I'm going to talk to you guys about is a little bit more along the lines of kind of calculating your home equity. But again, it is tailored a little bit more to Alberta residents and more specifically Edmonton residents. So if that doesn't pertain to you, feel free to skip forward about 30 seconds to a minute. If you're watching and recording this, if you're watching live, it's still important information. So I encourage you to kind of listen to it. So where do you sit in terms of home equity? So we went over the calculation previously about how to calculate your home equity, but where does that actually make you stand depending on when you bought? So the numbers we see on the screen right now are talking about the average home price in Edmonton for that particular year. Okay, so when we look at that first line there, we see Edmonton detached home prices. The average price of a detached home in Edmonton in July of 2020 was $436,000. Okay, so if you were a buyer in July of 2020 and you put 10% down, as you see in that column on the right hand side, that means based on the amount of mortgage that you've paid down to date, plus the increased value of your property, you've got roughly about $220,000 in equity sitting there. Sounds crazy, right? That's what sounds like a lot of money. That's seems like when you look at the number, about 50% of the property value, which is remarkable, right? Because the property value has gone up, plus you've paid that principal balance down on that mortgage. So there's a couple things working in your favor to actually building that equity. Now, the rest of the lines here are just a continuation of what we see on that first line. So if you purchased in August of 2021, the average price was about $466,000. If you put 10% down in 2021, you've got roughly around $184,000 in equity sitting there, just waiting. Right? Are you doing something with it? Are you not? Is what we're going to try and figure out kind of what you can do with it. So the purpose of this slide is to more point out that even if you came into the situation a little bit later, let's say in July of 2025, you purchased at the average price, of July of 2024, if you purchased at the average price of $552,000, you might still have up to around $77,000 in equity, which is, again, something not to shake a stick at. It's important and there's value there, and it is, locked in savings that you can gain access to. So it's important to realize this, even though you might have only purchased your home, a year ago, 2 years ago, 4 years ago, 5 years ago, even with as little as a 10% down payment, you still have substantial equity in that property that's just unrealized at this stage. So we're going to kind of go over some of the ways in which you can actually use that equity to your advantage, access it, then kind of go from there. All right, so here we have, again, real world example. So you purchased your home, hypothetically speaking, in 2020 for $436,000. According to average home prices in the Edmonton market, again, every market across Canada and the US is all going to be a little bit different. So realize that you're going to need to discuss your particular mortgage options with somebody local to your area, or just even discussing with me to see how it might vary from space to space, right? Currently, that same property is going to be worth about $578,000 without you having put a cent into renovations, anything of that sort. Just based on where the market trends have been over the last 5 years, your home could be worth roughly about another $130,000. Okay? Which means, based on you having paid down principal balance of that mortgage over those 5 years, you can be in a situation where you have over $220,000 in equity. So even if you bought more recently, like we showed on that last slide, you may still be sitting on a pile of equity that you're unsure about. And I'm happy to run those numbers with you to see if it's possible to find a solution for you to access it. Okay. So why does this all matter, right? We're talking about the numbers. Hey, your home's worth this, your home's worth that. You've paid $30,000 in principal here. You've done this or that. What does it mean, right? Well, all that time that's passed, of you making your mortgage payment month after month, week after week, whatever your payment frequency is, you've built equity. That money is not going to nothing. A portion of that is going towards interest, and a portion of that is going towards principal, which means it is getting put away, stashed away, so to speak, in the form of savings tied into your home equity. Okay? So if you've owned your home for a few years, chances are your property value has gone up, especially in the recent markets we've seen over the last few years. And this means you could be sitting on valuable resources, which is your home equity. And we can use that to do a variety of different things, okay? What I'm going to do over the next few minutes here is I'm going to show you how to access that equity, how to use it strategically to improve your financial situation, how to maybe upgrade your lifestyle or grow your investment portfolio. There's a lot of different things you can do with that. Okay? And bonus points, if you bought your home 10 years ago and you haven't done something like this, you've got even more equity. So again, Everybody likes to lean on their home as their home is a retirement plan. It's their nest egg. It's this, it's that. But you don't have to wait till retirement to actually reap some of those benefits, right? So what can you do with your equity, right? We're sitting here talking about equity. What are you actually going to do with it? Say, I got $220,000 in equity. What can I do with it? Well, the opportunities are endless. But here's a list of a handful of things that a lot of people will use that equity for. Okay? Because at the end of the day, we can access that equity at relatively low cost, which is going to make it advantageous to you to go and do something else with it. Let's maybe going to improve your investment portfolio, maybe help a family member out, or help you grow the lifestyle that you're interested in. So first thing on the list here, buy a second property. So in that example, I mentioned $220,000 in equity. $220,000 can buy a small condo in Edmonton. Certain markets across Canada can definitely buy a small condo, maybe a single detached home, right? So that would be a cash payment for a purchase of a property, of an investment property, a property that you wish to rent out. Now, again, if it runs into a situation where, let's say, we're talking about an Edmonton market and average detached home price of about $530,000 or more, $220,000 isn't going to buy that in cash. But what that will do is give you a down payment for that property. So again, it's going to put you in that situation where now you can utilize that equity to start building equity in new investments. Great opportunity for those people that are interested in growing their real estate portfolio and using the equity from one property to help do that. Okay. Another thing you can do with it, you can take that money out, you can use it to help renovate your home. We all know renovations are expensive. A kitchen can be anywhere from $30,000 to $60,000. Finishing a basement can be a substantial amount of money. Recently we've seen a huge influx of people interested in basement suite development. Maybe you want a little bit of a mortgage support payment, right? Somebody living downstairs in a legal suite, helping pay your mortgage down, helping you build equity in your primary residence, right? Maybe your equity is what it's going to take in order for you to renovate that basement to make it legal to that point of being able to rent it out. Okay. It can be used to consolidate high interest debt. Like I mentioned a little bit earlier, the expense and the cost with accessing your home equity is relatively low in terms of accessing credit because it's secured against real estate. So it's considered relatively low risk to lenders. So in that situation, if you're looking at consolidating high interest debt, if you've got credit card balances, car loans, line of credit, student loans, things like this that are at higher interest rates, it could make sense for you to refinance, pull out some of that equity to discharge some of those higher interest debts. I always say if you have equity in your home, you should not have credit card debt. Okay? It's one of those things that just do not go hand in hand. At the end of the day, your home equity is going to be a better use of your time, and your interest cost is going to be substantially lower than carrying other high interest debts. Okay? So if you can, use it to your advantage. Okay? Another thing you can do with it, you can help kids with school. University, college has gotten increasingly more expensive. The average bachelor degree, I believe, costs over $50,000 now. So there's a large part of the market that is interested in helping fund their children's education using their home equity. That is an option. Another thing is helping with down payment. We see in 2024, we saw about 30% of first-time home buyers utilize some form of a gifted down payment from a family member. Where's that down payment coming from? Not everybody has $220,000 in cash. But where do they have it? Oftentimes tied up in their equity. So again, another solution for you. Something else we can do is we can improve monthly cash flow with it. If things been a little bit tough, we know this market's been a little tough. The economy's been a little bit in the dumps. It's crap, right? What we can do, we can use some of that money to help make you feel a little bit more comfortable, a little bit of a fallback. Hey, maybe you can pad some savings a little bit, build that into your mortgage payment, and all of a sudden you're a little bit more comfortable for what life has to throw at you over the next 5 years. Okay? So here's just a small list of some of the possibilities. And again, we could sit there and talk about, dozens of different options to use the home equity for. For everybody, it's going to be slightly different. But at the end of the day, what we have to realize is this is low cost access to credit. That a lot of people are sitting on and they don't even realize it. Okay? All right, so this slide looks incorrect. It's supposed to say 4 ways to access equity at the top without selling, but it does say 3 ways. So we're going to say 4 ways because there's 4 examples set out on the screen. The first option is through refinance. So simply put, a refinance is replacing your current mortgage with a new one. And at that time, we can typically pull out equity in the form of cash. So again, I'm going to go back to a simple example of that $100,000 value. And let's say, hypothetically speaking, that mortgage is currently $50,000. Okay? With a refinance or through any of these options that we see here, the most we can access at any given moment is 80% of the property's value through these options. Okay? So what we can do is with option 1, we could refinance that mortgage as a $50,000 mortgage. That gets paid off with the new funds. And now we have a new mortgage for $80,000 on that $100,000 property. Okay. So in that example, that $50,000 mortgage was paid off from those proceeds. That means there's $30,000 remaining that was given back to you in the form of cash. Simplest solution for this. There's not a lot of moving parts to it. It's simply saying, hey, look, I'm getting a new mortgage. It's higher than my existing mortgage. And whatever that difference is, I'm taking out in cash. Now, what you do with that cash, lenders are going to ask you because they're required to ask you. But realistically, there's not a lot of limits in terms of kind of what you can do with that cash. Whether you're using that cash to pay off some higher interest debt, whether you're using that cash to gift to a child, whether you're using that cash to pay for a new vehicle, which, vehicle financing has gotten more expensive over previous years. There's a variety of different things that you can use that for. Whatever it is, that $30,000 is yours to spend. Okay? But your new mortgage is going to be an $80,000 mortgage. Okay? Option 2, we see a HELOC or home equity line of credit. So this is done through a refinance as well. But what this does is essentially set up a second portion to your mortgage, which is called the home equity line of credit. And this is a flexible line of credit secured against your home. And the only payments you have to make on that are interest-only payments. So I'm going to go back to that same example. $100,000 loan or $100,000 property. You have a $50,000 mortgage on it. Hey, I could really use, $30,000 in funds, but I don't need it today necessarily. So what you do is you could set up a home equity line of credit. Well, that home equity line of credit, you would set up through the refinance. So your mortgage would still be $50,000, but now you would gain access to a $30,000 home equity line of credit because, again, you can only go up to 80% total of the property value, which is that $80,000. So $30,000 home equity line of credit, $50,000 for the mortgage. So now you have access to a $30,000 home equity line of credit. You don't have to spend on it right away, but you have the option to do that later. And all your mortgage payments are based only on that $50,000 mortgage. So your mortgage payments continue based on only a mortgage of $50,000. But hey, if I need $30,000, I know I've got it like that. So the flexibility of the home equity line of credit is what really is the epitome of kind of accessing your equity. It is the most flexible. It is readvanceable. So let's say, I'm going to use that $30,000 example again, and there's a car and you want to buy it, it's $30,000. Boom. You put that on your home equity line of credit. Now all of a sudden, you've got a home equity line of credit balance of $30,000. You've got a mortgage of $50,000. So your total loan is still $80,000. But the payment on the $30,000 that's required for the home equity line of credit is interest only. So they're relatively small payments. So a great option for short-term solutions. Also a great option if you plan on discharging something quickly because, again, it's an open loan, so you can pay it off without any penalty. You can finance your car on that home equity line of credit and then pay it off the next day and not pay any penalties, any fees. Okay, and so it is a great resource. You can use that. You can gift that to a child. There's a variety of different things you can do with that, but it gives you access to that immediately. And then once you pay it off, you get access to it yet again. So again, it's revolving. You regain access to it when you pay it off. It's a great solution for re-accessing equity over and over. And the nice thing is majority of providers are going to offer a auto limit increasing version of this home equity line of credit, which means let's say I've paid my mortgage down to $40,000. Now my home equity line of credit balance limit is going to be $40,000 because 30 plus or 30 plus that additional 10 that we've paid off. Now all of a sudden you've got 40, right? So a lot of lenders will offer solutions like that, and it's great because if you set it up early, you just continue to gain access to a higher limit, and you don't have to go back and re-qualify and re-ask for more money because it's automatically built into this process. So again, flexibility-wise, the home equity line of credit, in my opinion, is one of the best options. Okay. Another option is called a blend and extend. This is a form of a refinance, but essentially what this allows you to do is keep your current rate and your current mortgage, but then what they'll do is they'll add X amount of funds to that mortgage at today's rate, and they'll blend those interest rates kind of together. So, to kind of give you a quick example, and I'm not going to spend too much time on this one because it's a little less common. But in a situation where, we have that same property value of $100,000, we've got a mortgage of about $50,000. Now all of a sudden we need an extra, $30,000, right? We would go back to our existing lender. We would say, hey, look, I need an additional $30,000. They would blend that $30,000 loan at today's rate with our $50,000 loan of, our existing rate, and they would spit out a new rate, new terms for it. So oftentimes the rates and terms that they use for these are slightly more expensive and a little bit less favorable, but an option nonetheless because it avoids you paying potential penalties by breaking your mortgage. So it is still an option for you, but again, it's not always going to be the best option, as none of these are, right? There's a reason why there's multiple options. Okay, and then the fourth way to access equity without selling is through a second mortgage. So you can actually obtain a mortgage in second position on your title. So when you obtain a mortgage, that mortgage gets registered on your title saying, hey, in the event that something happens with you or your mortgage, we're in first position to kind of take over this house. Now, what some lenders will do is they will step into second position behind your existing lender, and they'll say, hey, we're going to lend you some funds, usually at a higher interest rate and a higher cost, usually some fees associated with it, because they're taking on a little bit more risk being in second position, but they'll give you those funds. And in this situation, again, it's meant for more of a short-term option, or in a situation where you've got a very favorable mortgage in first position, and breaking it is going to trigger maybe high penalties or significant interest rate changes. These are things that we don't necessarily want to incur. That's the cases when a second mortgage is going to come into play. And that's typically provided in the form of a cash advance as well, similar to kind of that first option we talked about in refinance with an equity takeout. All right, let's move on. And obviously, if you guys want to access 100% of your equity, the only way to do that is to sell your property. Okay, so if you for some reason want, in that $100,000 example, you need $100,000. The only way to do that is by selling that property. Okay, there's regulations and rules in place for lenders, as well as risk caps for them to not go to that 100% value. At the end of the day, there's costs associated with a variety of different transactions, which is going to make it not favorable for them to go into that significant value. But I can definitely put you in contact with a handful of qualified individuals that would be capable of giving you a current market analysis of your property if you think selling your home is the right step for you in terms of accessing your equity. So again, I talked about it a little bit already, but what is a HELOC? Okay, so this is going to be the area that I'm going to focus on a little bit because, like I said, on the last slide, I do believe this is one of the most flexible and useful ways to access your equity because, again, it doesn't require you to take on costs immediately, but it does give you access to your equity for when you need it. Okay, so a home equity line of credit or a HELOC lets homeowners borrow against their home's value. So it kind of works like a large credit card. You can use the funds, pay them off, and then reuse them again. Interest is only charged on the amount that you borrow, not on the limit, just like a credit card. Okay? However, this is secured against your home. So in the event you stop paying, if you've got a balance on there and you stop paying, Just like with your mortgage, if you stop paying, you could find yourself in a situation where the lender could initiate a foreclosure process. Okay? So because it's security against real estate, it means there's something actually backing that loan, which means there can be action taken against it. Okay? Quick example, home value, let's assume the home value is $500,000. Total borrowing limit is 80% of that property value. We talked about that on the last slide, right? The maximum we can access without selling your home is 80% of the property's value, which in this situation is going to be $400,000. Let's assume you had a mortgage of $350,000 remaining on that property. That means today we could refinance that property for you and gain access to a home equity line of credit of $50,000 to get you up to that $400,000. So again, that equity is sitting there doing nothing for you right now. Whereas right now we could, start that process, gain you access to it. And then again, as you pay down that mortgage, you gain even more access to the home equity line of credit. And that brings me to this next part, to talk about how an auto limit increasing HELOC benefits you. So we talked about this a little bit again already. I'm going to deep dive down a little bit more. Okay. But as you pay down your mortgage, your home equity line of credit limit automatically increases without no need to reapply or requalify. Okay. It lets you access more of your home equity over time for whatever it may be, renovations, debt consolidation, or investments. Okay. Quick example, year one, let's say your mortgage is $350,000. You pay it down to $340,000. Okay. Your HELOC started at $50,000. Now the limit is $60,000 because you've paid that mortgage down. Now again, it's not dollar for dollar in all situations anymore. There's been some regulatory changes that have restricted the dollar for dollar change in this. But just for simple example, this is the reason why I'm using those. And then let's say hypothetically year two, you pay that mortgage from $340,000 to $330,000. Well, now your HELOC limit might increase from $60,000 to $70,000. Again, not exactly dollar for dollar, but to give you a little bit of an understanding as to kind of how that limit will increase as you pay that mortgage down. Okay. Benefits of this, pretty clear and simple, right? Access to funds easily, right? As your equity grows, as you make your mortgage payments, right? Or as property values increase even, you could gain access to more, and I'll kind of, go over that more with you in a separate discussion if we continue down that road. But it allows you to maintain liquidity without refinancing, right? Ongoing access to your equity. Right? And it's growing. It's growing. Every payment that you make, it's growing. Great long-term flexibility for future goals, right? If your goal is, hey, I want to buy some investment properties in the next few years, why not set something like this up? You can utilize those funds not only if you want to use them to help purchase, but maybe you want to use them to help renovate or do other aspects with those investments, right? This is an opportunity for you to do that at a relatively low cost, okay? So again, that auto limit increase, very, very, very favorable. The home equity line of credit, very flexible. Utilizing your equity, super important. Now, timing, very important. Okay. A lot of people will come and they'll say, hey, I am in a tough spot. I need to refinance for whatever the situation may be. Maybe, unsecured debt is, burying me. I'm struggling with payments. I'm this, I'm that, right? We want to get on everything early. Hey, my children want to buy a property. I want to provide them some gifted down payment in the form of some cash. I have a lot of money in equity in my home, but I don't have a lot in cash. How can we set this up for them? Realistically speaking, refinances, so setting up any of these processes typically can take between 4 and 6 weeks. Okay, maybe be able to be done a little bit quicker, but in most cases it's going to take that 4 to 6 week window. Okay. So if you're thinking this is something you're interested in doing, I always encourage, start the conversation early. Start the process early. Get the application going early. We can always push dates out here and there, but what we can't do is suddenly move things into a shorter timeline because it just doesn't work that way. There's multiple people involved. There's lawyers involved. There's lenders involved. There's land titles involved. There's a bunch of different pieces moving at once. And so we need to make sure that we're taking our time and getting it done in the right way. Okay. Another reason why timing is important is you want to avoid penalties when possible. There's a statistic out there that 60% of Canadians will break their mortgage within the third year of a 5-year term. Okay, breaking your mortgage means anything from selling a property, refinancing a property, maybe restructuring a mortgage in some way. But all those can trigger potential penalties. So if there's a possibility that we're going to be doing something midterm, we might want to have a discussion about kind of when your maturity date is. So let's say, for example, you signed a 5-year fixed mortgage, a year ago, and you come to me today talking about a refinance. Well, we're going to talk about when the best opportunity might be to do that to help limit your penalty exposure. Okay. If we realize that, hey, you know what, you signed 4 years ago or 4.5 years ago, and your maturity date is coming up in 6 months, it might make sense for us to just kind of push this to the 6-month mark, and then you're not going to face any penalties. So there's opportunities for us to kind of explore the best cost savings for you to make sure that you can actually utilize your equity, access it, and limit your exposure to potential penalties. Okay. Next best reason is kind of why timing is everything. Today's interest rate trends make this an extremely smart time to act. I said that at the beginning. That was the first slide I showed you guys that said, hey, prices are up, interest rates are down, we're in a good spot. Okay? The great news is when you're doing something like this is you have to qualify now, you don't have to qualify later. So again, if we're setting up that home equity line of credit, do it now. The risk that you might not qualify later could make it harder for you to access your equity later. So why not take that first step, do it quickly, take advantage of the situation and the market that we're in, and put yourself in a better situation for years down the road. So the next steps, what are the next steps? Well, we want to know how much equity you've built. That's going to give us the opportunity to actually discuss realistic options with you. Okay? If you just bought your first home, a month ago with 5% down, but why don't we strategize? Build a little bit of a strategy session together and see where we can end up together. Okay? So what I would encourage you to do is schedule a quick mortgage checkup. What I want to do, I want to look into your situation. I want to look at your mortgage, and I want to make sure that everything we're doing is working in your best interest. Okay? So after this meeting, and I think we might be back here. So after our meeting, we're going to schedule, that initial quick mortgage checkup. I'm going to look at your mortgage statement. I'm going to look at your finances. I'm going to try to get a little bit of understanding as to kind of what it is you're looking to do and maybe do with your equity. Okay? After this meeting, what I'm going to do is I'm going to build a personalized refinance report for you. Just going to show you what you can do with your equity, how much you can gain, what that cost is going to be, what your interest expenses or savings are going to be over the next X amount of years. Okay? We're going to follow up. We're going to build a strategy session. Say, hey, look, it might not work today, but here's what it'll look like in 6 months, maybe a year. We're going to strategize together. We're going to work together to make sure that we find a solution together. Okay? And then in doing so, we're going to develop a clear action plan tailored specific to your goals. We want to make sure that what it is you're looking to do with your equity, we're working together towards. So those are what the next steps in that kind of discussing what your refinance will look like are going to be. Again, I always encourage anybody to reach out. I mentioned my contact information at the beginning of this. You can reach me at dustin.wozniak@dominionlendingcenters.ca. You can call me at 780-965-6933. Again, my name is Dustin Wozniak, mortgage broker with DLC Mortgage Force in Edmonton. I'm happy to assist in any of your mortgage inquiries, whether it's a refinance, purchase, renewal, switch, whatever it may be. Again, maybe you just want a piece of advice as to a decision that you made recently or something you want to do in the future. I'm happy to have that conversation, but that is the end of my presentation. I wish you all the best. Thank you, everybody that tuned in, and I hope to hear from you guys soon. And go out there and really lean into your equity, guys. There's a lot of unlocked savings just waiting to be tapped into. So happy to have that conversation with you when the time comes. Thank you, and have a great rest of your evening.